Welcome to Econ Lessons. In this video, we're going to talk about fixed exchange rates versus floating exchange rates when it comes to international trade. And what are the implications for a trade balance and a country's currency and inflation? So intuitively, and in the collective unconsciousness of today, it seems that floating exchange rates is the way to go. Floating exchange rates is defined that each currency fluctuates against another currency freely. It seems like the free market, capitalism. For example, the US dollar would float against the British pound or the euro or the yen according to supply and demand. And again, each central bank would retain their own monetary policy and be able to control this, the value of their currency, and have an incentive to stabilize their currency, to create long-term contracts and facilitate trade. That's the argument. But what does history tell us about economics? And I'm going to show you, with this money and these Legos, that perhaps fixed exchange rates might be an optimal situation. In the 1970s, the remnants of the gold standard fell apart with Bretton Woods when Nixon closed the gold window. And almost immediately after that, the US started to run large trade imbalances. That means more imports than exports. And this didn't self-correct. In fact, the trend continued until the present day, in which we have politicians trying to, stick their finger in the dike of the dam in order to fix the leak, beating drums of political nationalism. However, better might be an understanding of what is really going on here. What's going on is one country's currency in relation to another is cheaper, and therefore there's an incentive to import goods. If Legos, for example, are cheaply imported from China, they come to the United States because the currencies are so cheap. The money in China is so cheap, everything is good. We can't stop it, we can't help it. And we're not just going to switch to exporting Legos to China because it doesn't make economic sense. So that's where fixed exchange rates come in. Fixed exchange rates are the yen is fixed to the dollar, or the pound is fixed to the dollar, or the euro is fixed to the dollar, and it's based on a gold standard, a classic gold standard. You also fix it to something like gold. So it has this anchor. When you have an anchor, it creates this self-correcting mechanism between the flow of gold and goods. Because gold, in one sense, is money. Even if it has paper, you have paper currency, the pegged currency will translate back into gold. So in one essence, we have one universal currency in the world, gold, or a commodity standard, pound sterling, etc. So when money flows in to the US, or let's say money flows into China because we're buying Legos, what will happen is Chinese goods will start to inflate, because the quantity of money theory states that the more money in circulation, the value of goods start to increase in terms of prices. Whereas in the US, our goods would be relatively cheaper. David Hume articulated this in 1749 in a letter to Montesquieu, and it was called the specie-flow mechanism, species being a commodity standard like gold or silver. And as the money flowed in, the quantity of money would increase. Irving Fisher picked up on this, and a lot of people under the classic gold standard realized that this was an optimal situation. It was only when we changed to a floating exchange rate as opposed to fixed exchange rates did the trade imbalance start to explode and the currencies got out of hand. Further, when you have a fixed exchange rate, you have discipline, because now you have essentially cut up a credit card and replaced the credit card of the central bank with a debit card. Spending can't go on forever, currencies can't be inflated forever. The implication is there are political incentives tied to floating exchange rates, and when central banks have infinite flexibility and control of their currency. We're under the discipline of a gold standard, a classic gold standard, and fixed exchange rates. This fixed exchange acts as an anchor, and the trade imbalance would automatically start to self-correct. The imbalance can't go on forever because, let's take the extreme example, all the money of the United States goes to all the gold goes to China. If gold is then their currency would start to, their prices would start to inflate ridiculously. And similarly, our prices would start to go down relative to China. And what do you know? Textile mills start opening up in South Carolina and Alabama and Mississippi, and we start exporting to China. So in the argument of fixed exchange rates versus floating exchange rates, you often have to turn to political economy, classic economic thought and thinking like David Hume and what was written back then. Because my underlying premise is often the classics thought and had time to understand the real mechanisms at work here. There are criticisms against the species flow mechanism and the fixed exchange rate. For example, that banks can increase the money supply just without even gold. However, if the gold standard is under a classic gold standard with discipline, that doesn't exist. So fixed versus floating, fixed is the optimal scenario, where floating is something we were born into, many of us, so we assume it's the best and it's the free market. But that's not necessarily true. Turn to economic history. Thank you very much, and don't forget to subscribe.